morning. Yeah. You guys, you're looking bored. Or is it the same insurance culture? Hope you can hear me. Okay, good morning. Well, thank you. Now, how many of us are from the underwriters side? We are from the underwriters, from the insurance underwriters. Okay, brokers and agents, insurtechs. Thank you. Tech companies that are not. Thank you. Banks. And those ones who just came in to also listen. Good. So normally, insurance has been one of the oldest tradition, except one that it says the oldest. I don't know. Yeah, thank you. You know which one is the oldest. So when we talk of insurance, I think one of the biggest tasks is understanding where it started from. So the day we will understand how it started and how it's been evolving, I think that's when we'll appreciate the steps or even look at how the future is going to be, so that we can move from risk to being resilient, helping businesses to be resilient. So insurance dates back in 4000 BC. Okay, I don't know if it's moving. I think it's not. Sorry, it's not. So thank you. So it dates back to 4000 BC. So at that time, who can guess what was happening? So it was a very simple culture. We had merchants who each of them has a ship. That's, we look at, mainly we look at the European countries. So you have got a ship, and let's say you sell wheat. So you put all your wheat in a ship or in your boat. Then someone else has got another different, maybe tomatoes, and they're putting it in their own boat. And then now they realize that when the boat, sometimes some boats will reach the final destination, others could not reach the final destination. So what they do, they had to spread that particular risk. You lower the risk by putting some of your grains in another person's boat, so that if in case it goes down, then at least it's not you who goes down completely. It's a group, so it's not everything that goes down. So, and then now they formed like a club, where in that particular club, you agree that this is the percentage that each of you carries for each other person. Okay? And so that was actually the origin of marine insurance, the one that we hear. Okay. Now, as it kept on growing, what happened was, you can change it to the next. I think this one is not working. Yeah. So as it kept on growing, so they started getting people who are not part of the club. Okay? So when the people who are not in the club started joining, they said, we need to have particular rules of engagement. Okay. Yeah, thank you. Some particular rules of engagement. For example, for how long are you supposed to be with us? How much kilograms of the other person's, weight must you carry, and all that. So that's what basically brought about what we call the policies, where you have the rules of engagement. Thank you. So the policies, from the policies, then it came to where you now, instead of managing that particular risk where you are carrying each person's, they said, okay, what happens if that boat went down, okay, or the ship went down? So it means that for you, are you going to be out of the club? So they said, then let's contribute some little money to be put as a fund. If it goes down, we can then build for you another boat, which then brings you back to business. Okay? And from that, then now they started contributing what we call nowadays the premiums. And then they extended those premiums not just for the boat or the ship, but to also include the amount of goods that you had in that particular boat or ship. So, and that's what basically brought in what within marine or even within transport, what we call goods in transit covers. Okay? And then it even went to the level where now we had this clubs like in London, we had what we used to call a coffee cafe, where guys used to wait for the ships to land and also to go to the various destinations around the world. So in this particular coffee shops, which was owned by a guy called Edward Lloyd, they had what we call bankers who used to finance. You want to get money to buy goods and maybe take them out there, they give you those particular the financing. Then we had underwriters, guys who now wanted to underwrite that particular risk, collect the money, and make sure that in case of anything, they are able to compensate you. We also had merchants, the guys who are now doing trade across the world. Okay, and so that's how then from that particular concept, they were able to. And this guy called Edward had all the information regarding which ship is going to land, which one is leaving next week. And so then guys could now buy the policies. You could sell the policies to those particular underwriters. And that's basically later on what came to be called the Lords of London. And that's where basically we have the highest level of insurances. All the insurances that we do here, part of that premium is given to the reinsurers. Then the reinsurers go and auction. So whatever cover you have here, they go and auction to the guys who can now carry the biggest risks. You see where I'm coming from? So basically that's how it started, and then it moved into the other countries now with policies and the likes. Now, what about in Africa? Okay. Did we have insurance? Did we have insurance in Africa? Yes. Now, when we were growing up, sorry, thank you. Thank you. When we were growing up, we had these groups where, if let's say all your cows die, what happens is the neighbors will give you their cow so that you take care of it. After 2 years, after 2 ndamas, 2 calves, they give you one. That was one way of managing risk. If a mother used to lose all their kids, what they used to do is they go out, and when the child is born, they go and give someone else that child to take care of that particular child. Okay? You are spreading the risk so that that particular risk is reduced. We used to have, during harvest time, we used to have groups of, the mamas in the village who could go to one farm, they do harvesting, then they go to another farm and harvest. It's basically because if you do it alone, it may take long and some of your produce may get spoiled. So basically they were doing that to reduce the risk. That's basically insurance. Okay? And by the way, like even Jubilee Insurance, how was it created? Very simple. It was a birthday of a child, and then when the guys came in to give present for the child, they contributed some good amount of gold, and then the person whose child had been was being rewarded felt so touched, and they said, "Can we use this money to create a fund that can support us in case of businesses going down?" And that's how Jubilee Insurance was born in 1937. So all this basically has been born out of the need for that kind of the need for support. Now, traditionally, how insurance works is we wait for you to get a loss, and then we compensate you, isn't it? So I wait for you to be sick, and that's why we have a number of clauses, and with a lot of exclusions. If you are sick, if I can't pay for vaccinations, you look at our traditional policies. I don't pay for vaccinations because that's preventative, right? I won't pay for your cars to be serviced. I'll pay for the time it gets an accident, right? And I won't pay for you to make sure you manage your fire in your building, all that. Even do some assessment in the right way and advise you. I wait for the fire to come, and then I do what? That's the time I come to compensate you. But now, you see, it's not going to be sustainable. And so I'll just then move, and I won't talk about the money that we are getting. So it's a very lucrative business, as you can see. Okay? In Kenya alone, it's 2.2 billion US dollars. That's around, that's almost 300 billion Kenyan shillings worth of business, excluding NHIF. And so we pay around 120 billion every year. So the rest of the money, the biggest percentage, we only make a profit of 100 million. So the difference basically goes in admin costs and distribution costs. So that policy you buy today for life, 40% will go to an agent who went around looking for that business, 40%. Then the insurance company has to play around with whatever is remaining. And that's why you see a number of insurance companies closing shop. You've seen a number of them, isn't it? Yeah, so then what are the challenges that we've seen? Just like the story I was giving you, there's always very low awareness of insurance, technology, a lot of infrastructure challenges. I think the majority of insurance companies, their data centers are either outdated, they're running using old systems, legacy, more than 10 years old. Okay, and so it's a very big challenge, of course, economic instability. Anytime there's a new tax coming in, you'll see a drop in how many people can buy insurance. So I remember there's a time we were having a conference with agents, and the first thing one of the agents said is, insurance is not bought, it's sold. It's because of the way it's been packaged, isn't it? So, and of course, like motor, you go there because it's regulatory. And then there's fraud. The talk of 40 to 50% is in fraud, and we are very poor in product innovation. So those are some of the challenges that we have. Now, to the topic for today, how do we then move from looking at insurance as a risk kind of venture into building a resilient organization, even businesses? So when you talk of resilience, we have around 5 categories. We talk of operational resilience. I talk quickly on what they mean. Operational resilience, there's strategic resilience, there's financial resilience, you must build that. There's the market shifts and triggers, which you have to be resilient against those, and then the adaptability to change. When we talk of operational resilience, what do we mean? If today, let's say you had a cyber attack, how quickly are you able to recover as an insurance company? If, let's say, half of your team today resigned, or again, Anguka Nayo came up, how quickly are you able to recover as an insurance company or as a business? Okay, so how quickly are you able to recover from the day-to-day operational challenges? Strategic resilience is how quickly how are you able to put your strategic initiatives that are able to adjust with the changing nature of the macroeconomics. So it's something that you must also look at as an insurance company, or even as an insurtech. Then we have got financial resilience. A number of the companies that we have are actually relying on the money you pay as your premiums to pay claims and salaries and all that. So they don't have a cover in terms of, in case anything happens. Today, if you stopped buying that policy, they'll most likely close shop. And that's why you've seen a number of them going into receivership. Then we've got market shifts. I mean, right now, Gen Zs have shown us something different. Their products, we were just speaking with Cindy from CIC, and they said, the products we have, are they going to be bought by Gen Z? Imagine you're telling them that your life policy, you will get a policy paid in 10 years. I mean, 10 years. Are they going to wait for 10 years? You are selling a pension product? Okay. So maybe I'll give you examples of what we've done in that particular stage, and also adaptability to change in terms of some of the old policies we have, the clauses we have are obsolete. How do we make sure that they are actually they're addressing the needs of the current system, clientele we are dealing with? So how do we build some of these resiliencies? Let me start with product innovation. I'll go from upper. When you talk of product innovation, it's about getting products that are relevant to the market. If right now you are sick, most likely you'll be given a waiting period if you bought a policy, because I'll take it as a risk, right? And then I have covers like maternity where I'll give you a 10 months waiting period. But actually, who told you that if I bought a cover for maternity, I'm going to give birth tomorrow, or I'll be pregnant in the next 3 months? Okay, so some of those we need to be very innovative in terms of the way we offer our products. So we have microinsurance. Actually, like there's a product we launched recently. It's called Cover Me, Coverbora. Coverbora, you get covered for inpatient at a price of around 5,000 shillings, and you can pay in installments. And so if you get an admission, then you get covered for it. We have products which even address mental health, because we have seen the cases where mental cases are increasing, COVID and financial stress, and you pay around 3,000 to get a product for mental health. So we are not giving you an exclusion because you have that particular condition. We are saying, you know what, you need to be treated for that. So these are in the area telematics. We have telematics for vehicles. We actually have telematics for your health. Okay, so as I'm making the steps here, we've got a Meshafiti app, which is measuring how many steps I've covered, and then it's also looking at my heart rates, my body pressure, and all that, a lot of other things that we're picking. Then I'm even able to predict if someone is likely to be admitted or what. And so we are using health telematics in our day-to-day. Then we also looked at how am I going to make sure that I'm able to recover if my systems, my infrastructure went down. So am I going to have another layer of other servers in the backend? So some companies then have moved to the cloud, including myself. So I run all my infrastructure in the cloud. Today, I've got a product I want to launch. I launch it in 30 minutes. I don't have to go doing a business case for whatever is required. Cybersecurity is also an area that you build resilience in your business so that you're able to sustain yourself. Using insurtechs, I have got like four projects that I've implemented, and I could not have achieved that if I didn't use insurtechs. One of them is using AI to adjudicate clinical claims, where within seconds, I'm able to know if, once you've been treated, what are you being treated for? Which other condition do you have? Are you being treated in the right way? What quality of care you want to get? And it's happening in microseconds within our systems. Okay, I could not have achieved it if I didn't use an insurtech, plus several other cases that we are using. Then we also have big data, robotics. I think my colleague, Leader, will be talking about robotics on what we've done. We've got a good robotics unit, which has done wonderful things in operational efficiency in the robotics space. And with that, thank you so much. I welcome you to today's sessions, hoping that we are going to share a lot and we are going to learn. And welcome on board. Thank you so much.